Hello, welcome to the Mutual Fund Show. The next 20 minutes, we'll talk about two key aspects of mutual funds. In fact, we'll talk to the two main aspects about mutual fund investing is to how to go about investing in equity funds and how to go about investing in debt funds. But we'll relate it to what's currently happening. Maybe it helps to be a bit proactive and try and understand what the impact on your schemes could be if you're parked in the wrong schemes. Now, because the world is changing at a hectic pace, interest rates, equity valuations, so on and so forth, maybe it helps to try and understand whether your portfolio should have some minor or major changes or no. To try and do that, we'll keep it simple today. We've gotten two guests with us, Mohit and Nikhil Kothari of Moneyfront and Etica Wealth, respectively, and they join us to tell us what is it that they are doing to their own portfolios and telling their clients to do. Chairman, both of you, thank you so much for joining in. Mohit, I'll start off with you and start off with equities first thing. Um, if there is a viewer who's come on the show today and she's not comfortable putting in lump sum money to invest into mutual funds because she fears that or she is of the belief that there is a bit of a period of uncertainty ahead, but still wants to invest that money, what is it that she should do? What is it that you would advise her to do?
Right. Hi, Neeraj. Always a pleasure to be on your show. Look, I think
Thank you.
obviously it's a known thing that markets have been a bit volatile of late, and relatively India has done exceptionally well. The U.S. markets, or let's say Nasdaq, for year till date has been down almost 29 odd percent. Sensex is up 4%, right? So the dichotomy is huge, and I can very well understand that investors are skeptical. They are sitting on the borderlines, they're wanting to invest, but they are also wary that yes, globally the markets are correcting, interest rates are on the boil, oil is on the boil, commodities are rising, so on and so forth, but the Indian equities are not relenting in this scenario. And look, honestly, appreciating the fact that we are extremely overvalued also, our suggestion to clients right now is to stagger your equity allocations, not jump in with lump sum. uh, Honestly, I think there's no point being a cowboy in this market. To be very honest, I think the relative outperformance is stood for almost 1.5 years, and it is perhaps likely that we might just relent under the tremendous global pressure, basically. So STP or an SIP approach, staggering out across next 9 to 12 months, could be the first best approach. A second thing on the equity front to all our clients is to be a little safe in the cocoon of large caps or flexi caps at best. Basically, I think that's a more safe zone right now. If you want to increase your allocations currently to equity, go towards this side. The third point, in the same breath, is that if you really want to get into equities, then also considering hybrid allocations right now, which could be a balanced advantage fund or a multi-asset fund, can be a great strategy. It gives you the best of both worlds, or perhaps in case of multi-asset, the best of multiple worlds, including commodities and some bit of REITs and InvITs and other things also. So kind of gives you an automatic hedge, kind of does the balancing or the asset allocation approach also quite automatically. So I think that's something which each of the clients should do right now if they are actually wanting to invest into equities.
Hmm. Well, just a follow up. If somebody's has a time horizon of over 5 years, because we've heard it a number of times on the show, that if you have a very long time horizon, then India still offers a really great opportunity in the broader end of the spectrum. So should that person also take the relative safety of the large caps, or is it better to do a staggered investment in, say, a mid cap or small cap funds?
Look, Neeraj, I understand that yes, it's a long-term story. Perhaps all markets are good in long term, right? I can't fault US markets for that matter, and even Indian markets for that matter. If you're investing for 20 years, yes, you can take a slightly more aggressive stance on the market. But to be very honest, I think we are all investors at the end of the day, and we would like our capital to work in our favor at all points in time. I would still suggest that given the way the markets are stacked up today, I would actually prefer a large cap or a flexi cap approach. The reason why I've included flexi cap is because to me they work like a pseudo large cap, but they will still have some 10, 15, 20 odd percent of mid cap allocation, and maybe a very minuscule composition of small caps. So they give you that dynamic flavor also across your portfolio.
Hmm.
But yes, I would rather go with that approach right now in the current context.
Okay. Okay, I'll come back on the funds as well. Nikhil, coming on the conversation, are you being conservative, or and again, it could be different for different time horizons, but I gave you my statistics, the viewer has a slightly longer time horizon in mind and is skittish about the near term. What would you advise her?
Okay, great. Thanks a lot for being on the show, for getting me on the show. So, Neeraj, see, Indian markets, as Mohit already highlighted, that have outperformed the global markets in last 1.5 year. So, from valuation perspective, we are slightly ahead of fair valuations compared to global markets. So, if someone has and we all believe that India has a great story. India's growth is the world is looking at India for the growth of the growth, and India will keep on getting capital. But even if you have a longer horizon, your entry points does matter. Okay, and when you start investing, if you invest lump sum right now, you may see that 1.5 year return is very much subdued, right? So that's why
Mhm.
the whole idea is what Mohit was saying. We also believe in that it's better to stagger your investments, but at the same time, keep an eye on the market. Whenever you see correction of 5-10%, try to use that opportunity, switching money from debt to equity that point of time. So you have to be slightly active also, that you keep your STP for 12 months, but at the same time be active that if market falls by 5-10%, use that as an opportunity and invest lump sum in that point of time. Apart from Indian markets, we are advising our client to take some global exposure also, because we've seen that Indian markets have outperformed the global markets for last 1.5 year, and there are few global markets which are looking very attractive from valuation perspective. Though there are some uncertainties in terms of growth, that's and in terms of the geopolitical thing, that's why the markets are corrected as compared to Indian markets. But if someone has a very low exposure to global or doesn't have any exposure to global, we believe that it can be a great time to add global funds in your portfolio, because you're buying at a lower valuation and you are getting a slightly diversification call. So when you're looking at global, I think there are a lot of funds. So if you look at China market, they are down. If you look at Hang Seng Tech Index, they are down. If you look at Taiwan market, they're all down. So last 1.5 year, they've corrected by 20.5%. So one can start investing in those market also, and an individual can take up to 10% of their exposure in global markets. And most of us have some global liabilities in terms of maybe our kids' education, maybe our own travel destination. So in that case, this also act as a hedge for your long-term goals. So we are advising a client to take a staggered investing approach in the Indian markets. At the same time, add some exposure
Yeah.
to funds in your portfolio.
Okay. Let's try and talk some funds. Mohit, so on the equity side, we're still talking equities. Mohit, um, fill us in on what are some of the better funds in each of the categories that you advise. Viewers, remember, the list need not be exhaustive. These need not be the only ideas that our experts would recommend to their clients, but this is used as some illustration um, for the conversations that we're having. Mohit, all yours.
Perfect. So yeah, Neeraj, this is not the entire list, but yeah, few of our picks would be, let's say in the large cap front, we prefer passive index fund. So out there, my choice is through ICICI Nifty Index Fund. On the flexi cap front, we can go with Aditya Birla Sun Life Flexi Cap, even UTI Flexi Cap for that matter. On the balance advantage side, Tata Balance Advantage and Edelweiss Balance Advantage are two of our picks. And on the multi-asset fund, through ICICI multi-asset, Tata multi-asset, even Nippon multi-asset to some extent. I think those are our picks in each category.
Interesting that the Tata mutual funds are finding presence place in your portfolios, Mohit. Especially in the balance advantage fund category is the first time I'm seeing somebody recommend these. Why so?
Look, I think the hot favorite in the market has always been through ICICI Balance Advantage. I absolutely like that fund, basically. But I think Edelweiss and Tata offer something different. Plus, the AUMs are still quite respectable in this segment. Pru ICICI is almost touching 40,000 odd crores as an AUM. It's a great fund, very neatly managed, and we still continue to have large holdings out there. But as an added new allocations, if you really want to consider two different themes, and I really like the way Edelweiss and Tata are working on that front.
Got it. Okay. Now, Nikhil, you mentioned relative safety of large cap, some global exposure, and something else. What are the kind of funds that people can go out and study and explore?
Okay, so we are looking at some funds on the multi-cap side. So that's why we're doing quoting multi-cap as an exposure to clients. We're also looking at value as a theme. So that's where funds like Temple India Value Fund has some exposure, or incremental exposure can be added there. On the global side, we're looking at few funds like a Greater China Fund or the Hang Seng Tech Index Fund. So we're looking at those global exposure as well as the US market, S&P 500 or Nasdaq options available. So we're looking at those funds as an exposure to add in the client's portfolio. But preferably Greater China Fund is one where we are very aggressively adding now on a client's portfolio.
Interesting. That's the yield-wise product. But isn't that subject to a bit of volatility and uncertainty because it's so exposed to China and buying those Chinese stocks? I mean, the markets out there have been very choppy to say the least, Nikhil.
Yeah, exactly. So that's what I'm trying to say, that in China, there is some geopolitical risk, right? So Greater China Fund, it gives you exposure to China as well as Taiwan and other countries. So it has exposure across the market. And second
Okay.
is that that's why we're recommending a staggered approach, because right now we don't know when the China will be out of woods in terms of the COVID restrictions
Sure.
as well as the restriction what they have. But and if you already have a sizable exposure in global funds, we don't recommend that. But if you're not adding, if you don't have global exposure or maybe 0.5%, 1% of your portfolio, we should start looking at that. And one more fund on the global side, we are also looking at PGM Global Opportunity Fund, which gives you exposure across the market. So primarily US. So those are funds which are looking at incrementally for clients' portfolio.
Interesting. Thanks for that. Now, Nikhil, the second piece I'll start with you, and that is on the debt side. So we've discussed equity and what viewers remember. I mean, you heard the rationale of both Mohit and Nikhil, and wherever you have more belief or you can combine this. But yeah, I think the common thread that is coming out from them is if you are trying to put money into equity funds, if you have running SIPs, great. But if you have a lump sum due to either a bonus or some favor of luck which struck your way, or savings that you had, don't do a lump sum investing. Do an STP or an SIP, as the case may be, into various categories, and those are the some of the funds that you could look at. Now we should focus to debt, because debt too has had various variables impacting it in the last 12 months. I mean, quite a news-heavy year. Nikhil, can I start with you? For somebody who's wanting to invest in debt, and I know different tenors have different kinds of funds, but for argument's sake, let's keep it simple. For somebody who wants to invest for a period of about 12 months, and for somebody who wants to invest just slightly over 3 years to take advantage of the taxation. So what is it that this person can do?
Okay, so personally, in debt categories, most of our exposure is going in target maturity funds. And some person who have a slightly longer horizon can look at dynamic type of funds. Okay, what I mean by target maturity funds is that the fund invests in paper which are maturing in line with the tenure of the fund. So if, say, for example, if fund is fund is there which is saying target maturity is June 23. So basically, you can invest in paper which are maturing in June 23 up till June 23. So one need to invest as per his horizon. So if you say someone has a horizon of say 8 months to 9 months, one can look at June 23 as a fund. So there, where he will get a return line with what is the YTM right now. If someone has a horizon of say 2 to 3 years, then someone can look at 25 or 26 as exposure. So there are guild funds which are maturing 26, 27, 28. So one can invest in those funds where 5 years is a reasonable time frame. If I take 27, so we may see the interest rate may go up slightly from current levels, but in a 5-year cycle, we are seeing that interest rate will be slightly lower than current level, or it won't be higher than the current levels. So if someone investing with a 5-year horizon can invest in 27 maturity, which will return in line with the target, the yield right now. So we are very bullish on the target maturity fund in terms of exposure when it's matching the client's horizon. Apart from that, if someone who is willing to take some amount of volatility in the short term, but believe that over a interest rate and ready to do a staggered investment in the next 6 months, and someone can look at long-term funds or a dynamic bond funds.
Okay. What are the kind of returns, Nikhil, that one can expect in target maturity funds per se?
Okay, so currently, if you look at short time horizon, then target maturity funds, the YTM is closing around 6.5 to 6.75, minus 30-40 basis point expense ratio. So one can expect 6.2 to 6.5 as a return. If someone has got 26, 27 as a horizon, then one can look at the yield is roughly around 7.3 to 7.5, and minus 40-50 basis point expense ratio, one can look at 7% pre-tax. So short term 6.2 to 6.5. If from medium term, 7% pre-tax, one can expect from that.
Got it. Okay. I'll come to the kind of funds in a bit. I believe all fund houses would have some of the other products. But before that, Mohit, can I come to you? How are you approaching this? What are you telling your clients on the debt side?
Look, Neeraj, I think on the debt front, there are two kinds of clients. One who believe debt as debt and they absolutely want safety and conservation of capital, and they are absolutely not okay with any kind of risk, even be the interest rate risk in the short term, right? So for people who don't prefer to have any volatility but just want consistent, even low returns are fine, then we are asking them strictly to remain at the short end of the curve and stick to ultra short term or money market funds, because that's where the volatility will be absolutely less, and they will give you a fair deal of around 6ish odd percent kind of a return, which is roughly the YTM in that range currently for those kind of funds, right? And
This is for a particular time frame, Mohit. Sorry, I'm interrupting you.
any time frame from, let's say, 1 month to around a year,
Okay.
kind of a parking. And even though if you want to go ahead, let's say 1.5 2 years, it won't harm you, though. Yes, or at that tenor you can perhaps try and increase your yield by getting into other instruments. But yes, this is absolutely fine for anyone who wants to invest beyond a month or 2 months kind of a period. Right, so that's on the short end. But if people who are okay with some amount of interest rate volatility in the portfolio, because our opinion is that the interest rates will further go up, the yields are likely to harden further up, basically, and you might see some amount of volatility and some amount of what do you say, interest rate markdown in your portfolio related to that, right? So if you are really okay with that, then I think what Nikhil said makes absolute amount of sense, to go into target maturity funds. You align your investment horizon with the kind of tenor the funds are offering, and there are target maturity funds across the spectrum these days, right from 2025 up till 2032-33 maturity. You will find a scheme or multiple options for each year, right? So if you really want to go for 5-7 years, go ahead. You will get the indexation benefit, tax will become highly efficient, and the paper quality is absolutely clear. These are highest rated papers. You will have all AAA, PSU, SDL kind of portfolios, and the yields are very, very attractive right now, Neeraj. The yields in all these portfolios is somewhere in the range of around 725 to 750, 775 even for 2030 kind of maturities, right? So it's a great option, but there will be some volatility next 1 year. People have to be cognizant of that. It won't be a straight line.
Okay. Okay. Now, Mohit, come in with the names of the funds. What are, I mean, for example, if they are taking target maturity funds, what are the options there? And from a short end perspective, would most products be homogeneous, or are there one or two which examples that you can give?
Look, on the short end, Neeraj, if you're looking for April, specifically or March maturity 2023, I would rather go with a DSP savings for a March maturing portfolio and April 23, Edelweiss Bharat Bond, April 23 paper. These are on the short end. On the money market side, I can go with Aditya Birla Sun Life Savings Fund or a Pru ICICI Money Market Fund. And on the ultra short term, you can pick up, actually, there's not much of a difference, but yeah, ICICI ultra short term or an Axis ultra short term is a good option. On the roll down of the target maturity funds, there are plethora of options. Honestly, the names are extremely confusing for investors to remember, but I would rather go with few thumb rules out there. Look, Edelweiss Bharat Bond has been the most successful target maturity series ever done in this country, and they were the pioneers actually to start this trend in the world of debt mutual funds, right? So anything from 2027 to 32, I think, or 28 to 32, you have Edelweiss Bharat Bond series available for all the maturity years. They are the highest quality papers with the lowest expense ratios in the market, which is extremely important when you invest in a debt fund. So I would suggest that anyone looking for between options, then you have many CRISIL, SDL, PSU paper combinations, CPSE paper combinations. These are all written down in the nomenclatures of the scheme, so you can go ahead and pick it, because these are finally all indices, and the funds are just mirroring the index, right? So they are fairly safe, and the paper quality is high, so you can choose either of them.
Nikhil, what are the kind of funds that you are looking at when you recommending the categories that you did to your clients?
So basically, as Mohit rightly said, the fund are more or less homogeneous in terms of what exactly they offer. So, like say for example, someone looking at March as a time horizon, which is 5 months down the line, then one can look at PGM Money Market Fund or DSP Savings Fund. If someone is looking at June as a horizon, then someone can look at Birla June 23 as an exposure. If someone is looking at say a 5 to 6 year horizon, then right now we'll rather prefer a GSEC over a SGL or a PSU combination, because the spreads are very narrow right now. So there we are recommending IDFC Guild Fund 26, 27, 28. You have three options there. So depending on the client's risk appetite, someone is willing to take slightly higher interest rate risk, then we'll recommend 28, and someone will take a slightly lower interest rate risk, then he can look at 26. So those are three options what we're looking at in terms of exposure. Now, maybe once yields slightly harden from here, then one can look at 32 or 30 as an exposure, but may not be right now. If you're looking at staggering your investment and want to take that interest rate volatility in your favor, then I'll recommend that you can go for 32 also, but in a staggered manner, not going as a lump sum right now.
Okay. Gentlemen, I heard a term over the last 2 days. I mean, so what should people do if they have existing investments in constant maturity funds? These would be homogeneous or similar to target maturity funds, Mohit?
Not exactly, Neeraj. The constant maturity is a different category by SEBI, and they are mostly 10-year gilts actually in the portfolio. So the category is called 10-year constant maturity fund, right? So out there, the portfolio is fairly long dated, which is exactly 10-year kind of a maturity, exact as in the nearing 10-year maturity portfolio. So the interest rate sensitivity is fairly high in the portfolio. But if people are holding, look, you're almost nearing the peak of the interest rate cycle, if not there, right? So you are at around 720, 730 on the 10-year yield. Perhaps at 8%, yes, I would say that, okay, just start entering in at the longest end of the curve, whenever or wherever you can get opportunity. You are not there. You will see some good markdown impact on your portfolios as you move towards that range, and you will certainly move towards that level, basically. So there will be some volatility. However, the accrual yield on the portfolio will be fairly high, should be somewhere in the range of around 750, 775 for that kind of a maturity. So that's okay to hold right now. For people who are waiting for that level, anything upwards of 775 on the 10-year, I would say start getting into the long end of the curve. So it could be a 10-year constant maturity, or even a fund like a Nippon Nivesh fund, which have papers like 2042, 2043 maturity. So it's a 20-year kind of a portfolio. It's a fantastic portfolio for someone who really wants to build a long-term debt portfolio. If you want to build a long-term 20-year debt portfolio, go with that fund. It's a great fund to be in, and just ride the interest rate cycles as they come along the way.
Okay. Nikhil, very quickly, you want to add something before we wrap up?
Yeah.
On the target.
Okay. So constant maturity fund are completely different to target maturity fund. So the difference is that constant maturity will always have 10-year paper. So after 1 year, they will still buy a 10-year paper. And with target maturity, the maturity will keep on coming down. So in terms of risk level, the target maturity fund will have a lower volatility as compared to 10-year constant maturity fund, if you're looking at those things. But so constant maturity is someone who wants to play an interest rate volatility and who believes the interest rate will come down, they should look at constant maturity fund. If someone do not have an interest rate view and hold till the fund till maturity, then they should look at target maturity fund.
Okay, gentlemen, Nikhil as well as Mohit, thank you so much for giving us this time and telling us both on the equity side and the debt side. And I'm sure these answers are very, very helpful to a bunch of people who are thinking of investing currently by the mutual fund route. So I really appreciate your time, both of you.
Thank you.
Pleasure, Neeraj. Thank you.
Yeah, and the pleasure was entirely ours. And viewers, thanks for tuning in to yet another very informative episode of the Mutual Fund Show.